Good morning, everyone. Welcome to this webinar from TreasuryONE and Finance Ghost, where we're going to take a look at what happened in the year of 2022 and what to expect in 2023 from the market. We got Andres here, he's literally just walked away quickly from his desk. He's going to present to us today what's going to happen. But I'm going to hand over to Finance Ghost to welcome you all as well for the first one for 2023. Just as a side note, there's a chat on the right-hand side. If you've got any questions, you're more than welcome to post them there. We will tackle all your questions as we go.
Thank you so much, Vichar. Welcome, everyone. Welcome to 2023. I'm pretty stoked to see we had the most registrations we've ever had for a TreasuryONE webinar with GoSmell this morning. Obviously, with load shedding, we'll see not everyone will be able to attend, but it's lovely to see that coming through. So I think that speaks to the quality of the insights that the TreasuryONE team brings us every morning in GoSmell, which I'm very grateful for. I think they do a wonderful job of giving us that kind of global perspective on currencies, commodities, all the stuff that I'm not watching nearly as closely as the actual equity side that I focus on. But very excited for this morning. I think we're going to look at what to expect in 2023 and look back a little bit on 2022 as well. You are very, very welcome to ask questions at any point in the chat. So what will happen is Andre will do his presentation. It'll probably be 20 minutes or thereabouts. And then we can have a Q&A at the end. We'll wrap the entire session up by around 9:45. So don't be shy to send the questions through as we are going. And then we'll address all of them right at the end. So Andre, over to you. And yeah, personally, I'm really looking forward to this.
Thank you very much, Finance Ghost. Thank you very much, Vichard. And good morning to everybody that signed in that does have power and inverters and solar panels and everything that we can name generating in electricity. I thought it well to start off by taking stock of 2022 and then go and look at what do we expect for 2023. Now, if we go to 2022, then those four little pictures really depicts what really happened in 2022. We had the Russian invasion of Ukraine right in the beginning of the year in February last year. And that pushed Brent crude oil prices to $120 per barrel, subsequent movements in fuel prices all over the world. But it didn't stop there. What also went up, and that's because of the European side being very dependent on gas from the Russian borders. And that gas prices went up almost 300%, which led to quite a bit of a crisis in the European Union because they had to stock up, make provision for a very bad winter. Fortunately, the winter wasn't as bad as they expected, but nonetheless, that increased their inflation significantly. And the oil prices that went up to $120 a barrel throughout the world had an impact on shipping. It had an impact on fuel prices and subsequently impact on inflation. So we had a bit of an inflation problem throughout the year. And because of that, add to that the massive printing of money of 2020 and 2021 during the COVID period, the heightened period of COVID, led to as I say, the inflation going extremely high, and then central banks had to jump in and increase interest rates significantly throughout the world, except, and we'll get to that a little bit later, one place in the world where it didn't happen, but most people increased interest rates significantly. And that placed emerging markets a bit under pressure because as US interest rates, for instance, went up significantly, people started moving money out of emerging markets back into the US because they started earning interest there and the possibility of even getting higher interest rates. So that was the more or less situation for 2022 and the dominating factors. So if we then look at that and then we go forward, then the themes for 2023 is still going to be rising interest rates to slow down inflation. And then obviously the knock-on effects that will come in this year in terms of world economic growth. Is there going to be any growth? Is there going to be recessions? How does it look? That's going to be one of the main themes. Then, of course, with the rising dollar and much higher interest rates, that can most probably also lead to a bit of a problem because of the higher interest rates and the bigger interest burdens on sovereign markets, sovereign debt. That could lead to a bit of a crisis. We know that emerging markets, in a lot of cases, is slightly over borrowed, paying a lot of interest in dollar terms. And if they cannot afford that because of economic growth that slows down and so forth, it could lead to a bit of a debt crisis in emerging markets. China has had a zero COVID policy all along, and it's only now in the beginning of this year that they are moving towards the change of that and lifted all restrictions, including the travel ban, and for the first time allowed people in. But now we see that, and as I read, that there's a lot of countries bringing vaccination policies and so forth to the forefront. I've read this morning that there's now a move that they might want to bring back masks being worn on airplanes in America and so forth. So yes, China has moved out, but this whole COVID thing still seems to be lingering, and I'm being a little bit afraid that it might take a bit of a front foot step through 2023 if we see massive increases in infections again. Inflation then will remain key, but if we look at the graph on inflation, then we can clearly see that inflation has definitely turned. So this is a graph with quite a few countries, Chinese, CPI, European Union, etc. And we can see that on all levels, all the graphs has made a turn. Some more than others, some less, but definitely a turn in inflation. So it seems that the higher interest rates that was produced for us by central banks to the detriment of consumers and to the detriment of economic growth certainly worked, and we are seeing that there is a turn. But we must remember that with that, the help came from oil prices that stabilized and gas prices that stabilized, shipping costs that then obviously stabilized, fuel prices that started coming down, all contributing positively to the inflation. So not only the interest rates that contributed there is factors, key factors in the markets throughout the world that assisted in bringing inflation down. And we will have to see whether that persists or whether there's a change. But so yes, inflation will most definitely be at the forefront for the whole of 2023 and to be observed and watched very closely. Along with that, obviously, your PPI figures, job creation, etc. But inflation will remain key. Going on, I said earlier that we'll get to that. There's one country, and that's Japan. Now, we've seen that the Japanese yen at one stage last year weakened significantly to absolute almost record levels. Their inflation started rising as well, but we know that in the little world of Japan, they've had negative interest rates for a very, very long time. For the last 10 to 15 years, they've had negative interest rates. And they still sit with that, and they still haven't done anything about their interest rates. We're expecting the new inflation rate to come out this week. We expect that to hit 4%. And just this morning, after the central bank meeting, they've once again decided not to rise interest rates or do anything about the situation of inflation. So Japan, a bit of a problem. But one of the key things in Japan that one needs to take into account is that they've been for the last number of years desperately trying to kickstart that economy. They've had several monetary stimulus plans, fiscal stimulus plans that was implemented and came out, and none of those actually worked. So for them to raise interest rates is a bit of a problem because the economy is still not kickstarted. However, they have another key problem, and that's in terms of their demographics. It's a very rapidly aging amount of people that sit in their country, and they spend less and less. As I've always said, old people don't buy new fridges, they don't buy new televisions, they actually grow smaller. And there's less and less young people coming through to kickstart that economy. That's a problem that actually now spills over into China with a declining economy, and also in Europe. It is somewhat of a problem in an aging population. And when I speak about populations, there's an interesting one that will happen this year, and that's that the Indian will be the country with the biggest population. They will actually overtake that of China this year, and they will be the country with the biggest population. But so, yeah, inflation remain key, but we are watching Japan closely to see whether they're going to change on their interest rate policies, because they're the one country that have not really done anything about rising inflation. I stick to the inflation. It started turning, higher interest rates lacing the pressure on the economy. Inflation expectations going forward, and that's the graph on the right-hand side and the one on the left-hand side, clearly shows us that inflation expectations by consumer sentiment indexes, everything is clearly showing us that absolutely everybody, all the economic data that comes out, everything shows towards a sharp decline in inflation. And this, the right-hand side, is the US inflation. On that first one that I showed where all the countries was represented, it didn't clearly show up as much, but we can see that America being the biggest economy and being watched by everybody very closely, we can see how sharply their inflation have turned. The latest figure came out at 6.5%, and if that continues, then there's interesting implications for interest rate policy and so forth in America. Having said that, the Fed is almost at peak interest rates. Now, they're sitting at 4.5%. They've hinted that they might move to slightly above 5%. At one stage, they said 5%. Now they've said slightly above 5%, which says that their interest rates might have another 75 basis points in it. And a 75 basis point increase in interest rates, that will not come as a negative blow for their economy in one go. Chances are that they will now only increase interest rates at 25 basis points at a time, and with a maximum of 75 basis points in total. So we can clearly then look at that as saying that interest rates nearing its peak in the United States, and then pointing to a downward move when you get to the end of the year, beginning of next year. And that will heavily depend on how the further increased interest rates will impact on their economy. Now, I didn't prepare and I didn't want to bore you with too many graphs, but if you go and look at the housing starts, housing sales, construction, in other words, everything surrounding housing, then the housing market is in a worse state than it was in 2008, before the financial market crisis, when Lehman Brothers went under. It's in a worse state than what it was in 2008. You also look at their car sales, you look at a lot of other figures coming out, economic data coming out of the US, and it clearly points that that economy is actually slowing down quite significantly. And that will definitely make the Federal Reserve think twice before they actually now move aggressively on interest rates. So at this point in time, the markets tell us that they will only increase interest rates by 25 basis points at a time, with a maximum of 75. My prediction would be that they will most probably not even go another 75 basis points, but they might stop at 5%, and we might only have 2 further interest rate increases of 25 basis points each going forward for the rest of the year. And coming towards the tail end of this year, I would not be surprised to see a Federal Reserve actually reversing their interest rate increases and start looking at lowering interest rates. Once again, from what I've said now, is that if you look at the US yield curve, then it's the most inverted since 1980s. So clearly, what they've done so far on interest rates has definitely worked. But what the yield curve also tells us is that they expect the Federal Reserve to slow down and actually start moving lower on interest rates at the back end of 2024. Recession risk. Europe is an interesting, the monthly global tracker drops 2.1%. So the risk of recession slightly lower. Now, why would that be? Well, Europe didn't have such a bad winter as they expected. They had enough gas reserves. What they've done in the lead up towards their winter in stocking up on gas and having alternatives was sufficient to get through the winter. We're not quite through the winter as yet, but we're getting to the end of that, and didn't impact as negatively. And I say as negatively because it did impact negatively, but not as negatively on their economy and economic growth as was originally anticipated. And it's now thought that where everybody spoke about recession in Europe, that they might avoid having a recession in Europe. And with China coming back on, reopening, and let me go to that slide. With China reopening, it can soften a global recession because as they come back on ground, they are the second biggest economy. Trade will open up with China for a lot of economies. It will have definitely an impact. That's where ships and was standing in harbors and where everything was slowed down. That could change, and that could soften a recession blow for the world as they come back onto the market, being more active. And keeping on that trend, with China coming back on stream, we've seen metal prices rising quite significantly. Gold lost a little bit of its color this morning and yesterday, but really nothing serious. So with those China coming back, metal prices rising, and that's purely, showing us that people expect the recession fears to subside a little bit and growth starting to come back. Now, a lot of times last year I said that I think from the middle of this year, we could see world economies coming back onto growth. We might see that being kickstarted a little earlier, call it in the second quarter of this year. And that would, as I say, go back to a Chinese more normalization throughout markets in terms of economics. And that would all help people move away from this recession fear. And this is an interesting one. You just need people to move away from that fear of recession to actually start thinking a little bit more positive, get out of their houses, buy a few things, spend a little bit of money in anticipation of better growth, and that kickstarts economies. So not all doom and gloom. Gold's been a star, but I think we all know that. The Russia invasion lifted the gold, Federal Reserve sank it and rising again on recession. And now with metals rising as such, gold is just picking up a little bit of steam as well. Will debt place an extra burden? Definitely. Cost of debt reaches 3% of GDP. So that's the one that I mentioned right in the beginning, one of the themes for this year. That could be one of the brakes that get slammed onto economies, especially in emerging market space. We know that in the first world, they just print a little bit more money and they just make a little bit more debt to pay their own debt. But the focus is always on emerging markets because there's possible defaults, people not being able to pay their debt, and then those defaults is got a knock-on effect onto banks and so forth. So that's clearly something that we have with the cost of debt that rose immensely in 2022, that we must watch closely how emerging markets perform in terms of this higher cost of debt and whether that's affordable and how that spells out doom and gloom for their economies. Because that money that you take out there takes money out of their fiscal side, takes money out of the economies, money that cannot be used productively in terms of job creation and so forth. And that's a problem. So we'll watch that very closely. And whilst I speak about this, there's a lot of people that might think, what about South Africa? Now, I'm going to move on to South Africa, but I'm going to speak about South Africa here now when we speak about that extra debt burden in terms of emerging markets. We are not faced with that debt problem in terms of dollar outflows or euro outflows. Our foreign debt in South Africa as a percentage of total debt is actually relatively small. And the bulk of our interest payments is not linked to currency at all. And we've got a far less impact of that rise in foreign currency outflow or interest payments for dollars. We are only hampered by that with the rise in interest rates locally, because that's where the bulk of our debt lies. And yes, our long-term bonds did increase significantly, but in a lot of cases, your interest is linked to the interest where the debt was issued. And we did not incur that much new debt during the high interest rate period. We will recall that Mr. Godongwana had actually repaid a little bit of our debt because he had an inflow of extra funds from the mining sector and from the financial sector banks that paid a little bit of extra tax, and he could spread that and even repay a little bit debt. And the budget deficit was then much smaller, so the demand to go out and borrow extra money during this period of high interest rates was actually very, very low. So we are slightly cushioned against this extra debt burden because of high interest rates. Now, what will happen in South Africa? And at this point in time, if I read all the news and I look at all the news, then the South African public, South African businesses, everybody must be at a heck of a low after a December, after a January with stage 6 load shedding. And the feeling, the sentiment of South Africans, absolutely, I think, at relatively big lows. So if we look at Eskom supplying less and less energy, electricity, then you don't need a very clever person to read this graph. You can see the slow down energy intensity graph here, less and less and less, and the impact of that on GDP is it's just amazing. I mean, all you need to do is to pick up the phone and call somebody and ask for something to be done, a job at your house, or you need to go to a shop. I mean, I don't know how many shops I've walked into where they say to me, we can't accept your card, we can only accept cash because of load shedding. Or we can't supply you with this because of load shedding, or you have to wait for this because of load shedding. The worst, of course, I had was going to a holiday place where the pool was green. I rented a house and the pool was green. And they told me it's because of load shedding, which I explained to them, no, that's not because of load shedding. That's because there's not enough chlorine in the water. But we know that at this point in time, and I'm mentioning that simply because everybody uses load shedding as an excuse. Now, it is an excuse, but to some extent, it also made us very lazy because there is an easy excuse. But that's not going to stop. If I look at the last week and the discussions, and there's very little assistance from anybody, people don't want to participate. I mean, Cyril Ramaphosa called a meeting and people simply didn't even go to the meeting because they don't want to be involved in this. I've read this morning that they say it's political sabotage. I think it's this sabotage as such at our power stations. And it is a massive problem. And we've been hearing for the last 18 months now how they're going to bring renewable energy be on track and so forth. And still nothing's being done. So yes, they can come up with plans as much as they want to, but this is going to be a massive problem going forward. We've got Mr. Godangwana sitting in Davos, telling people that it will be something of the past between the next 12 to 18 months. 12 to 18 months, but considering that we've been coming for the last 3 years, is simply not cutting it to investors anymore. So it creates a very negative impact on our investor confidence. It creates a negative impact on the economic growth. It creates a negative impact on how people feel and how they spend money. I've mentioned that earlier. You need to feel positive to actually go to a shop and buy something. Otherwise, you only buy what you really need. But apart from that, the cost of electricity, the impact of that going forward, takes more and more money out of people's pockets. And this is going to disaster effect. And sorry that I'm going on so much about electricity, but it's one of our biggest negatives in the country at the moment and not being sorted out. And I fear that the communication that we get from the authorities is also not very well. So we'll have to watch this very, very closely in terms of investment into the country, economic growth going forward, and the impact of that on our inflation rate. Because with an 18% increase coming through in the middle of this year on electricity, it will have a very negative impact on our inflation rate, and a very negative impact on our inflation rate will have a negative impact on how much movement the South African Reserve Bank has got in terms of interest rates, which if I then go to our repo rate, it seems that it can normalize. My expectancy is that we will see at most 2 more interest rate increases of 25 basis points each. So in other words, a total of 50 basis points. It's either going to be one move of 50 and then stabling out for the rest of the year, or 2 smaller increases of 25 basis points each. But as I've just spoken about electricity a lot and the impact of that on inflation, growth, etc., if we have a very slow downturn in our inflation rate because of the increases in interest of electricity having a negative impact on inflation, it will slow down what we can expect from the central bank. And the talk about changing a central bank policy by government does not help either. Because if they were to then lower interest rates just to satisfy the public feel or the government feel or the change in their policies, will have a further negative impact on inflation. So this is a space that we have to watch very, very closely. But yes, a spike in inflation because of a spike in the cost of doing business and being fed through to the consumer could slow down the normalization of the repo rate and could place pressure on the repo rate. In terms of trade, was slipping. We've seen that towards the end of the year. But maybe with the reopening of China, that can help us a little bit and change that again and put us back on a better path. Our graphs certainly looks that it is changing. So yes, the war, I mean, if we look at that change, then the war and all the things of 2022 had a dramatic impact. But going into it's the end of 2022, beginning of 23, we are seeing a change there. And I think that will continue. The rand performance, we are still, if you look at the right-hand side, in a very, very undervalued situation in terms of where the exchange rate is trading. That's because of the dollar that was on a very, very strong footing. And obviously Eskom's impact on the exchange rate. Now, in what I've said, if we look at America and peaking interest rates pointing to lower interest rates towards the back end of the year, Europe not really going into recession or likely not going into recession, then that says most probably the dollar could be in for a bit of a bad time this year, relatively speaking, and that could filter through to a rand in for a better 2023, increasing in value slightly, mostly because of a decrease in the value of the dollar against euro and pound, etc. But the negatives, big one, we have to watch very closely what happens with our own economy in terms of economic growth and how that will be slowed down with whether we can do business and whether we are able to attract investment into the country because of all the negatives in the country. Open for questions.
Thank you. Thank you so much, Andre. Thank you to everyone who has started to send their questions through. So look, some of this will be probably some repetition of what's in the presentation, but my approach is always, if someone's asked, it means someone else is thinking about it and didn't feel like asking. So it's always worth running through these questions. So the first one is, what is the likely effect of global recession risk on South Africa? If you could summarize it in a sentence or two, Andre, what does a global recession mean for us this coming year, if it were to come to pass?
A global recession would simply mean that we export less to the rest of the world because the demand will be less. And that will negatively impact on our terms of trade, that will negatively influence our dollar inflows. But it will also be positive for the fuel price, for instance, because a global recession would simply mean less demand for oil. Less demand for oil would spell lower fuel prices. Lower fuel prices for South Africa would be a good thing in terms of our inflation, but it is our biggest import. So that less exports would be counted completely by the less imports of oil. And historically, the rand has actually performed better during times of bad economic growth because of a standstill in what happens in the world. So yes, the biggest impact would actually be from job creation that we desperately need. That would be the biggest negative impact of a world recession.
Thank you very much. Then there's a question around, what do you mean when you say our interest rates are not linked to currency? I think that comment was made earlier in the presentation. Just a clarification on that.
No, I simply said that because, when I speak about the rise in interest rates and the debt burden, or the interest burden for especially emerging markets that's slightly overextended in borrowings, especially on their sovereign side. South Africa is not. So because there's a 3% rise in interest rates, does not simply mean that we've got so many dollars that we borrowed or so many euros that we borrowed that this high interest rate and increases interest rates will lead to a massive outflow of currency out of South Africa because we have to pay these higher interest rates. Our foreign debt is actually relatively low. So the interest that we pay is local. It's paid in rand. It doesn't have a dramatic impact. That rise of US interest rates doesn't have a dramatic impact on the cost of our South African government debt.
And then there's some questions around commodities, gold, metals, how that's doing. I mean, gold is finally actually starting to do something, it seems, after I've had a very painful period of holding the thing. It's always super hard to guess where that might go. But, any views on that, Andre, around gold and just the metals in general this year?
Okay, so in everything that I've said, I've actually brought forward my expectations of a change in world economic growth, where a lot of people only speak second half of the year, third quarter of the year, where we'll see a change in economic growth and sort of coming back on stream and looking a little bit better, with expectations of interest rates going lower towards the back end of the year. I bring that forward and say that we might even see that kickstarting in the second quarter of this year, that people start feeling a little bit better, and that the general feel of recession and economic growth changes more positively. And that will have a positive effect on the demand for metals. Because if most of the metals is not gold, you need it to produce. And if we're going to start producing better, and if China is going to come back on stream and doing better in terms of their economic growth because of the lifting of COVID regulations and so forth, then the demand for metals will be there. And because of the demand for metals, the prices will remain elevated and slightly on the increase.
Thank you so much. Then there's a couple of questions here around just rate increases in general. One on the US side, if US inflation is starting to trend down, why would the Fed still want to potentially do another raise? And then even in South Africa, with Eskom hurting us so badly, should the SARB not be looking at cutting rates sooner in 2023?
Yes, the SARB should be looking at cutting interest rates, but let's go to the US first. Look, there is still a big gap. The inflation target of the United States is 2%. It's still at 6.5%, and their interest rates, their current interest rate standing at 4.5%, is still below what inflation is. So ideally, you normally want your interest rates to be slightly above that of your inflation rate. So they still have room to move. They still have an inflation problem. The fact that it's turned does not say that they don't have an inflation problem. And if you don't manage it properly, it could very, very well and easily turn around and go back up. So you don't want people to run out into the streets immediately. You still want to sort of pull them back a little bit and say, hold on, guys, we still have an inflation problem. Our inflation is still at elevated levels, still way away from our target levels of 2%. So you still want to increase a little bit, but you don't want to kill anything. So that's why I say 25 basis points, and I don't even think they'll go 3. They'll only go 2, maximum of 2 interest rate increases. So I'm lowering my forecast for the rise in interest rates in the US to 2 and not to 3, and only 25 basis points at a time. And I'm actually bringing forward my lowering of interest rates to the last quarter of this year, where they will turn. I think they just need to see a continued downward path on their inflation. But at this point in time, still a problem. Looking at South Africa, yes, we should also lower our interest rates, but to kickstart growth. But and I think Mr. Gonangwana said that many, many times before. Inflation is a bigger problem than trying to kickstart the economy. And the economy cannot be kickstarted by a change in monetary policy. Monetary policy and fiscal policy has got to work hand in hand. And at this point in time, our fiscal policies are not complementing anything. There's no productive spending on that. They're not really doing anything. So we need these things to work hand in hand. Also, from a private sector perspective, we're not seeing massive new projects being kickstarted or being done. We're not seeing this massive inflow of investments into the country. So you've got to remain vigilant about inflation. And I've mentioned how dangerous our situation is. We've already got an 18%, a 19% almost increase in electricity prices that comes through in July. And the spin-off on that, or not the spin-off, the impact of that on food prices, the impact of that on anything that you sell, anything that you produce in this country is going to be disastrous. So to lower interest rates now and get people to run into the streets and go and run up debt, and then before the end of the year, you sit with an inflation rate of 10% because of that, and then you have to double interest rates to try and stop that, is not a very prudent thing. So no, I don't think we're at that point where we can do that. We have to also make damn sure that our inflation rate comes down closer to the target levels of between 3 and 6% before we actually start looking at lowering interest rates.
Andre, I'm going to give you a break now. I'm going to take a couple of them. So Ziad's asked a couple of questions about tips on investing in this market, locally versus offshore. I think Ilana had one, if I had R1 million, where would I invest it? So look, I think the reality is that, this year is probably going to be tough again for a lot of equities. I think South Africa obviously is at the moment scoring a lot of own goals. I mean, we know this. We are lagging emerging market inflows. Load shedding's caught up with us here. I think this is not a terrible year for diversification. I think to only have your money in SA equities, I'm not sure that's ever been a great idea. And I think that's just getting worse by the year, to be honest. Sometimes we have a year where we catch up in relative terms because offshore markets are just hell of expensive and we look cheap. And those are swing trades. If you're looking for stuff to invest in and kind of forget about, then you've definitely got to recognize that South Africa is a tiny little part of the world, and there's a lot of other stuff to find elsewhere, that's for sure. But, the other point is you can now get yield, whereas sort of a year and a half ago, you couldn't really because interest rates were so low. So now, if you are paying off a mortgage, you've got to ask yourself, anything else I invest in needs to beat more or less 10% a year after tax as a return, because otherwise you should just be paying off your mortgage. Now, that is not so easy at all, actually. So for a lot of people, honestly, this year should be about getting debt down, giving yourself that space. Recessions are ugly things, and people can get very nasty surprises from losing jobs, from losing businesses. Just building up a balance sheet buffer is not a bad thing at all. If you are paying off debt, I think to bring that down, obviously, the goal in life is always get to the point where the debt is kind of gone and now you've got extra cash. What do you do with it? If you're in that situation, again, you need to look at your yield opportunities. If you can go and earn 8% or 10% on something, borderline guaranteed, right now, that's not a terrible way to go. If you've got enough ammo to get into alternative assets, which is sort of your debt-led, private equity and that kind of stuff, look, you have to have quite a bit to be able to invest in those structures, but they can be very good. If you're looking at the broader market, then I think my overall advice would be, the bigger the multiple you pay for whatever it is you're buying, the bigger the risk. I use the analogy of the Proteas and the Springboks at the moment. If the Proteas beat England in the upcoming tour, we'll all be ecstatic, right? Yes, look at us. This is fantastic. We can play cricket again. When the Springboks win, it's almost kind of assumed that they'll win, right? It's a big disappointment when they lose. But after that test series in Australia, if the Proteas lose, it's kind of just expected. That's how investing works. That's how value versus growth investing works. The value stock right now is the Proteas because they're on a low multiple and there's room for upside. The growth stock right now is the Springboks because when they're disappointed, it hurts us. They just keep going and going and going and going, right? The Springboks are Microsoft. The Proteas right now are a very broken JSE small cap. And so the problem is in a recession, when you've got significant risk of disappointment, ultimately, you've got to just look at sentiment. You've got to look at the risk of that disappointment. Like, why do share prices move? Obviously, they move because of underlying earnings. We know this. But they also move because of changes in sentiment. That's what drives the multiples. And that's what actually moves a share price far more than its earnings. If your multiple unwinds by 20% or more, as we've seen on the market in the last year, it almost doesn't matter what your earnings did. I can almost guarantee they didn't grow fast enough to actually deal with that problem. We've seen it in the real estate industry as well. There was a question about the impact of load shedding on real estate landlords. I mean, there are obviously huge costs coming through for them. You know, it's all good and well to keep the lights on at Canal Walk. What is that costing Hyprop? A lot is the answer. What does that mean? Well, I'd love to be able to sell them renewable energy solutions. Those are the guys making the money right now in a big way. And, you know, Schroeder released something on Sens this week where their property valuations came down again. Why did the property valuations come down? Because investors are demanding more of a yield. So property, for example, has this great inflation hedge. It's all good and well until yields are going in the wrong direction and you couldn't put the rental increases to your tenants, or your net operating income didn't go up enough because you're spending so much on load shedding and energy costs and all of that kind of thing. So it's going to be tough. I think it's hard. I think there's a lot of China coming through now in a lot of these companies. There's big momentum in some stocks, you know, where China is a thing. If you look at sort of Nike's share price in the last couple of months, even though in the US they are really struggling with having too much inventory, actually it's the China story that's been kind of driving a little bit of a recovery there in Nike. I think Richemont, I skimmed it while you were talking, Andre, they released this morning. And obviously sales in mainland China well down. But now as China reopens, you know, what will that mean for Richemont, for example? Because luxury goods tend to be very defensive. I'm sorry, this is a long answer, but there's one more point I just want to raise, which is just be careful of defensive stocks in general, especially the stocks that people tell you are defensive. So grocery retail is the oldest trick in the book on this. Grocery retailers make a lot of money from selling stuff that has nothing to do with groceries. So health and beauty products, for example, carry a much higher margin than fresh goods. Now, we all need to go and buy food. We know this. That's a given. But that's not what is inside the earnings of these grocery stores. It's the other stuff they make. It's the health and beauty. It's the clothing. It's the general merchandise. That's actually what drives their margin. And that's not defensive. So one of the ones that I keep shaking my head at a little bit is the multiples on something like Clicks or Dis-Chem. You know, the problem is you're paying a huge multiple there, and a very large portion of their margin is not made on pharmaceuticals. It's made on small appliances, or it's made on health and beauty products, or it's made on organic foods. This stuff is not recession-proof at all, not even close. So, yeah, just be careful. I really think that overall, if you're paying off debt right now, that's probably the right thing to do. Give your balance sheet some space, and if you've got extra money over and above that, then look at opportunities very carefully and ask yourself whether it's giving you enough of a return over, you know, what the cost of debt and the yield would be that you could possibly get somewhere else. Andre, I think we might have space to ask you maybe one more. I'm going to touch on Gerald's question here, which I think is pretty interesting, which is OPEC, right? And they try very hard to control the oil price, even when demand, you know, potentially is not behaving itself. And there's just and this is obviously with reference to your point around, you know, what happens to oil prices in a recession. How much can OPEC really influence that in a genuine recession when demand is falling like that? Can OPEC really still control the price to an extent, or do they just become price takers like everyone else?
It's a very interesting question. And if we look at it, then at the end of the day, we look at business economics. OPEC would love to control the oil price, but they cannot just withdraw oil to push up the price because they need cash flow as well. They need to fund their operations. They need to pay taxes to, well, it's mostly government owned, but they need the money to run the country. So to a lesser extent, they can influence it more and more. And so I'm not quite sure that they can so aggressively control it. And I'm also not of the opinion that this whole Russian war and sanctions on Russian oil will influence it that much. At the end of the day, it's a question of supply and demand. And the supply cannot be stopped because you need the money for your operations. So less of an impact, less of a possibility to really control it.
I think one that I'll touch on, and then I think it's time to wrap up actually. It's just a question around companies within the renewable energy space locally that have caught my attention. So, you know, this is renewable energy now is the buzzword, right? So it's the old story. Is now suddenly everyone is trying to figure out how to look and feel like a renewable energy business. I think the reality is that a lot of this is still taking place in unlisted companies. I mean, at the moment, the people running around selling solar systems for your house, that's not a listed company, right? Those are the people who were selling hand sanitizer a year and a half ago. No, I'm just kidding. There are obviously a lot of, very, very good people doing that. Of course, there are a lot of chancers who are now solar experts as of 2 months ago. So please just be careful in general. But, in the renewable energy space, I think the one that always comes up, although I must be honest, I don't know a lot about it. So go do your own research. That's Reunert. They've done, they've said they're going to go and target renewable energy. The one that I see come up a lot is LEs, which is not renewable energy. That's just like the little inverters. But then everyone forgets everything else that's inside LEs, which is struggling. So people tend to get ahead of themselves. The other one is Mustec, with, again, like inverter type solutions. I think Mesa has a lot of that. I speak under correction. But again, people forget, okay, that's great. But what is the demand for, desktop computers right now? As for Renogen, which I see as a question come through there, well, there was only one SENS from Renogen in December, which is about 100 SENSs less than their monthly run rate. So there's a little bit of a worry there in the market in general. It's gone very quiet at Renogen. I'm sure everything's fine, but it has kind of gone quiet, hasn't it? We came from a place where there was a SENS update, almost every week about what the management team was having for breakfast. And now we're at a place where we're not hearing much. And the last few announcements were a little bit of a challenge. So maybe there's some delays there. I'm sure the thing works, but there are some delays there. Look, in general, I think with this stuff, just be careful. It's very easy to go and buy into the story and this narrative. There are to my knowledge, there are no obvious really pure plays in this space. And it's generally part of another group. And you have to look at what is in the total group from a renewable energy perspective before investing in that. So yeah, just be careful.
Yeah, Finance Ghost, if I go back to the question of Ilana that you answered very correctly, and then to end off, a word of advice from my side. My grandmother, who died 40 years ago, who would have been well over 100 years now, gave me some excellent advice when I was a young boy. And she said, don't put all your eggs into one basket and be cautious when you do. Today, the people say, diversify your portfolio. It sounds far more cleverer than what my grandmother told me, but it comes down to exactly the same thing. The same on everything. Take caution when you invest and don't put all your eggs into one basket.
I think that's it from us. Vechart, you want to end off?
Yeah, thanks everybody for attending. I think it was very informative. And we'll definitely look forward to hosting the next one down the future. Thanks for everybody attending. It will be available on YouTube afterwards. So if anybody wants to have a listen again to it, you're more than welcome. And Finance Ghost, thanks for giving us the platform to present it and give your audience another opportunity to learn what's going on outside there. And Andre, thanks for presenting.
That's a pleasure.
Thank you, everyone. We'll see you at the next one. Ciao.
Cheers. Bye-bye.